Welcome to another TCP walkthrough video. I'm Logan, and in today's video, we're going to be going over calculating capital losses and utilization for C corporations. And we're going to be doing that the SuperfastCPA way, which is diving straight into questions to learn the material. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and watch our free 1-hour webinar training. We teach the key ingredients to passing the CPA exam, and again, it's only 1 hour and it is free, and we will teach you how to be effective and efficient to pass your exams. Also, just letting you know, we will only be going over 5 questions in this video, but Superfast CPA members will have access to the full 10-question video when we post it in the members forum. So if you like this, you can get more of it and more practice by becoming a Superfast CPA member. With all that said, let's dive straight into the questions. Okay, here we are at question 1, and as you'll see as we dive into these questions, this topic isn't super difficult on the CPA exam, and maybe doing it in real life is difficult, but for these questions, you'll see that it's not too bad. So let's read this question. Maple Corporation incurred a capital loss of $50,000 in the current year. The corporation also had $200,000 of ordinary income and $30,000 of capital gains in the same year. How much of the capital loss can Maple Corporation utilize in the current year? Okay, so if you don't really know much about capital losses and capital gains, when it comes to C corporations, that's okay. Let's dive straight into the answer here to learn how it works. Okay, and the answer is $30,000. That's how much of the loss can be used this year. C corporations cannot use capital losses to offset ordinary income, unlike individuals who can offset up to $3,000 of ordinary income with capital losses. So that could be something that might have caught you up or might have confused you if you remembered capital losses with individuals. Capital losses for individuals, they can be used to offset ordinary income up to $3,000 of ordinary income, but with C corporations, they can't do that at all. Therefore, Maple Corporation can only utilize the capital loss to the extent of its capital gains, which is $30,000. The remaining $20,000 of capital loss can be carried back or carried forward according to the tax rules. And we'll learn about that in just a second. But yeah, you can't use capital losses against anything else other than capital gains when it comes to C corporations. So that's the most basic idea there. Let's go to the next question to start learning about other rules for capital losses and C corporations. Okay, here is question 2. Oak Corporation made $500,000 in the current year, 2023, with total expenses of $450,000, resulting in a net income of $50,000. Additionally, Oak Corporation incurred a capital loss of $70,000 in the current year. The corporation had the following capital gains in the previous 4 years. 2019, $25,000 gain. 2020, $10,000 gain, 2021, $20,000 gain, and 2022, the most recent year, $15,000 gain. How much of the capital loss from the current year will be carried forward? Okay, so obviously, even if you didn't know much about capital losses, this is implying that some of it can be carried back against these years, which will then affect how much of it will be carried forward. Now, if you have a general idea, go ahead and pause the video and see if you can get the calculation. If not, let's go ahead and go straight to the answer to learn how carrybacks and carryforwards work for capital losses. Okay, and the answer is $25,000 of it will be carried forward to the next year. So let's read through this. C corporations can carry back capital losses to the 3 preceding tax years and then forward any remaining losses up to 5 years. In this case, Oak Corporation will apply the capital loss to the 3 preceding years, 2020, 2021, and 2022, starting with the furthest year of the 3. So right there, we learned that even though it provided us with 4 years, we can only go back 3 years. So having 2019 there was kind of to throw you off. And you apply it starting with the furthest year, and then you get closer. So start with 2020, apply $10,000 loss to that gain, and then if there's still a loss to be used, use it in 2021. If there's still a loss, use it in 2022. So in this case, we were able to use the loss to offset all of the gains from the previous years, and there's still a remaining $25,000 loss that then is carried forward for up to the next 5 years. And again, it has to be used against capital gains in the future years. Okay, now we learned that capital losses can be carried back 3 years and forward 5 years. Let's go to the next question. Okay, here is question 3. Birch Corporation incurred a net capital loss of $80,000 in the current year, 2021. The corporation decides to carry back the loss to previous years. The following are capital gains reported in the preceding years: 2020, $20,000, 2019, $30,000, and 2018, $25,000. How will the net capital losses be treated in the years they are carried back to, and what is the remaining loss to be carried forward? Okay, so kind of similar to last question, we have to figure out how much is used in the previous years so we can know how much is carried forward, but it also throws in, are these short-term capital losses, long-term capital losses? How are they treated in those years they were carried back to? So you could probably do this question, except for maybe how they're treated if you don't know how to do that, but you could probably figure out how much is carried forward. So pause the video, do that calculation. It's very similar to the previous question we just did. And when you're ready, come back, we'll learn a little bit more. Okay, the answer is B. It will be treated as a short-term capital loss or short-term capital losses, and then there's $5,000 remaining to be carried forward. So we probably don't need to dive too much into the calculation. There was $80,000 of capital loss to be used. It offset all of the capital gain in 2018, all of the capital gain in 2019, and all of the capital gain in 2020, leaving $5,000 left, and that is the amount that's going to be carried forward. But the biggest thing we wanted to learn from this question is right here. Net capital losses are treated as short-term capital losses in the years they are carried back or forward to. So in general, no matter if it was a long-term capital loss or a short-term capital loss, when it's carried back or forward, for tax purposes, it is treated as a short-term capital loss. All right, we learned one more thing. Let's go to the next question. Okay, here we are at question 4. Willow Corporation has a taxable income of $100,000 for the year 2021. The corporation also reported the following gains and losses: short-term capital gain, $15,000, long-term capital gain, $10,000, short-term capital loss, $20,000, and long-term capital loss, $25,000. If there was also a net capital loss carry forward from 2020 of $5,000, what should Willow Corporation's taxable income be for the year 2021? Okay, so in this question, obviously you need to figure out what the net capital gain or loss is, and we also need to figure out how the net capital loss carry forward from 2020 might affect all this. So pause the video, think about it, do the calculations, see if you can get the right answer, and when you're ready, come back, we'll look at it together. Okay, and the answer is $100,000. So the taxable income doesn't change. It'll make sense when we read the explanation. So first we have to net the capital gains and losses. So first we net the short-term capital gains and losses, and that gives us a $5,000 loss. Then we net the long-term capital gains and losses, that gives us a $15,000 loss. But in the end, specifically when you're talking about a net capital loss for tax purposes, it doesn't super matter, whether it's short-term or long-term, because again, like we learned in the previous question, it's all treated as short-term losses when they're carried back or carried forward. So in the end, it's just a $20,000 capital loss. Since C corporations cannot use capital losses to offset ordinary income, the net capital loss of $20,000 does not affect the taxable income for the current year, and neither does the $5,000 net capital loss from 2020. Therefore, Willow Corporation's taxable income remains at $100,000. So just to say it one more time, net capital losses are not deductible in the year they're incurred. And that should make sense because you don't have a net capital loss until you've netted all the gains and losses together. And that would mean that there were more losses than gains. There's no more gains for the current year. So obviously you can't use that loss against any gains in the current year because they're all gone. So it can't be used in the current year and it doesn't affect taxable income. And then the carry forward, same thing. There's no gains to be used against, so it will be carried forward still. All right, let's go to the next question. Okay, here is question 5. Spruce Corporation has a taxable income of $120,000 for the year 2021. The corporation also reported the following gains and losses for the year: short-term capital gain, $25,000, long-term, $30,000, short-term capital loss, $10,000, long-term capital loss, $15,000. In addition, Spruce Corporation has a capital loss carried forward from the previous year of $20,000. What should Spruce Corporation's taxable income be for the year 2021? So very similar to the previous question, but might have a different outcome than last time. So pause the video, do the calculation again, and when you're ready, come back, we'll look at it together. Okay, the answer is $130,000. So let's walk through the calculation one more time. You net the short-term capital gains and losses, giving us a $15,000 gain. You net the long-term capital gains and losses, giving you another $15,000 gain. Total capital gain is $30,000. And again, we're not too worried about the tax implications of that in this scenario because we're just trying to figure out what the taxable income is. So next we consider the carry forward from the previous year. And in this case, we can use it because there is a gain to be used against. So we subtract the $20,000 from the $30,000 gain, giving us still a remaining $10,000 gain. And we add that to the taxable income. Again, it's not necessarily ordinary income. The capital gain isn't ordinary income, but it is taxable income. So the total taxable income is the $120,000 ordinary income plus the net capital gain equaling $130,000. So a different situation here. Capital gains do affect taxable income, and capital losses can't be used in the current year, whereas capital gains are obviously taxed in the year they're incurred. Okay, we learned a whole bunch about net capital losses for C corporations. Before we go any further, let's do one more part of the process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You will notice, oh, hey, net capital losses can be carried back 3 years and carried forward 5 years, or different things that you've seen multiple times throughout the questions. It's obviously important according to your review course, so you write it down as a pillar topic so you can remember it for later. So let's go ahead and look at the pillar topics for this video. Okay, here are the pillar topics. And again, pretty straightforward topic once you understand it for the CPA exam. This kind of stuff is horrible to do in real life, having to figure out how it affects the previous year tax returns and everything. But as far as the concept, it's not too bad. So first, to calculate a net capital loss in a year, subtract the total capital losses, both short-term and long-term, from total capital gains, both short-term and long-term. If the result is negative, it represents a net capital loss. Pretty straightforward. C corporations cannot use those capital losses to offset ordinary income at all, though. They can only offset capital gains. And that's where the whole thing of this video comes in. Therefore, they're actually carried back 3 years and carried forward up to 5 years to offset capital gains in those years. Now, as far as how those capital losses are treated, they are treated as short-term capital losses in the years that they're carried back or forward to. And then finally, we talked about this at the very end, capital gains do count towards taxable income, and carried forward capital losses can offset current year capital gains, reducing the taxable income. All right, those are the pillar topics for this video. Again, not too bad. Thanks for watching. Before you go, make sure you go check out our free 1-hour webinar training on SuperfastCPA.com. Again, it is only 1 hour, it is free, and we will teach you the key ingredients, the key strategies to passing the CPA exam. Also, if you liked walking through these 5 questions with me, remember that Superfast CPA members will have access to the full video when we post it in the members forum. So again, if you like this, you can get more of it by becoming a Superfast CPA member. If you like the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.